Okay. Hi. Let's have a chat about the move contracts, which if you have been the blog post published on the website, which I did, a couple days ago, basically. that explains basically everything you kind of need to know about the move contracts from any sort of fundamental perspective and how they work and so on. So this is not what we are going to do here. Obviously, if you have any additional questions about these move contracts, let me know, and I will answer that. But for the purpose of keeping this fairly short, I just wanted to make a video of how I actually do trade these. So there are a few things that I haven't mentioned in the article. First of all, it is basically because these contracts are fairly thin. There is not so much liquidity, as you can see. The volume and the order books are kind of thin, so you need to first of all execute these properly, and also don't I kind of didn't want to share too much, because sharing this all publicly could cause any kind of a decay of the edge. This is not the same thing when I talk about using some concepts for trading Bitcoin, for example, where obviously the volumes are huge, so it's not going to change any sort of strategy, because the execution and everything is safe. But when you have markets like this with this amount of volume, that it can cause an issue if you tell too many people. So there are basically two things how I trade the move contract, and before I go to that, I want to share with you this website. It's a moveproject.io. Here you can actually see all the historical move contract charts that traded since I think 2019. So everything I'm going to talk about here, you can easily kind of backtest for yourself. There are another great things here. You have a expiration history, you have expiration averages for the week, and some other things. There is a backtesting tab, which I haven't tried, but for the things that I will talk about, that are easily backtestable, but you still need to execute them properly for you to make any kind of money. So first of all, the shorting the move contract. Some of you probably understood from what I posted. If you take a look here at the expiration average per day of the week, you can see that historically the Saturday and Sunday has the lowest expiration day prices, which is kind of a obvious thing, because obviously there's not many things happening during the weekend. So how this is going to kind of look like on your PNL chart is that you basically open, let's say this is the Saturday contract, this is your price, and this is kind of a move contract price here. So the Saturday contract will open with some sort of strike price, and market will be kind of trading at the same point during the whole day of the Saturday. And the move contract, on the other hand, is not going to do that. It will stay flat at the beginning, but then the time decay, the data decay will kick in, and it will start trending down, although the price will stay flat. So this is basically how you make money on the Saturday move contract. So the first one is the Saturday one, which I will be talking about. First of all, the execution. I short the Saturday move contract at the London close on Friday, which is at 6, basically between 6 and 7 p.m. GMT. Okay, this is the time basically on Friday, because the Saturday move contract will be available for trading since Friday morning basically, but you don't want to be short. You don't want to be short immediately because obviously it can be affected by Friday price movements. Fridays tend to be kind of normally volatile day, so you want to be shorting the Saturday contract when the volumes from Friday trading kind of started drying down, which is around this London close on Friday. If you trade something like ES, you will also notice that after a London close on Friday, markets tend to really slow down. So this is where I short the move contract. Another thing is the stop loss. Obviously, you need to have some sort of invalidation. Funnily enough, on Sunday last week, basically on Sunday last week, we had a, let me actually take a look on a date. It was the Sunday 27th, basically. It was this, Bitcoin buy, which basically draw the price pretty high, 22.03.27. And as you can see, this is how price closed. I was short this, from around here. It was sitting in a nice amount of profit, and then I got completely, blown out. I wasn't at home during the whole day, and I just came back. I was trading without a stop loss, so I just came back here, and market was already trading here, so I just basically closed it for the loss. But obviously this is not something you want to be doing. Overall this is kind of unusual thing. If you will spend any time backtesting this, you will see that move like this on Sunday evening is quite unusual. If you take a look at the Saturday contract, this is more of a thing that you will obviously experience during the weekends. So how to set up the stop loss for this? I've been playing around with this myself, but I think I found out kind of the most kind of a safe way, or whatever, or the way that makes sense to use your stop loss. So let's say that the move contract, when it's going to open, it will have some price for itself. This is calculated by the DWAP of the last 30 minutes and the first 30 minutes of the contract, so of the previous contract. So as you can see here, this move contract opened at, let's say, $900 basically. What you want to do when the contract is going to open is, let's say this is the exact time when contract did open. You are going to go to the indicators on TradingView, and you will take a look at the ATR range and stops, this second version basically. And if you take a look at the settings here, you will have different kind of ATRs that kind of give you the expectation for the next hour, the current day and previous day ATR. So you don't need to look at all of these, but you will have the current day ATR, which is obviously very simply calculated by plotting the ATR, the average true range indicator, which obviously I cannot, which is here, and it's obviously calculated from this. So what you want to do then is measure the sides. It's $1,300 from here, and then it's $1,500 to the downside. You will take the longer side, which in this case is obviously this one, here, and you will then subtract the price of the move contract from this 1,500 price. So basically you will end up with the 600. This, I think it's quite self-explanatory. The 1,500 minus 900 equals to 1,600. So you would open your trade here, and you would put your stop loss $600 above the price. So if you are opening one BTC, you are risking approximately $600, and you can see that this contract then expired at around $100. So you are basically making around 1.3 R trade basically. The move contract trades and shorting volatility overall, the risk reward is not huge. This is quite a different approach from classic discretionary trading. When you are going long or short and betting on the direction. These trades have low risk reward ratios but high win rate if obviously executed properly. So this is how you place your stop loss when you are shorting volatility. The Saturday contracts, I always let them go to expiration. So I'm not going to touch this thing. The FTX will close your trade automatically, at the midnight on Saturday, basically when the contract expires. In regards to stop loss, when this contract moves approximately $500 to profit, which would be around here, I move my stop loss to break even. Okay, you can do that even sooner, but the $50% benchmark from the open is kind of a great point to keep this thing systematic and just move your stop loss to break even and let the rest expire. Okay, so this is how I do the Saturday contract. To recap this, you will use the ATR indicator, measure the sides from the price action, pick up the longer side, and then subtract the 1500, which is this number right here, from the price of the move contracts, and you will get the $600 stop loss, which you will then place. And Saturday one, you are running it for the expiration, and at the 50% gains, you will just move your stop loss to break even. When it comes to the Sunday one, okay, and this is a little bit more complicated, depends on how much money you will be using. Obviously, these move contracts take quite a bit of your margin, so if you are only having one contract open at the time, basically any time during Saturday evening or when the Saturday contract is going to close, you will just roll your position into Sunday one. It's still better thing to do than shorting a weekly contract for the weekend. Okay, so do these 2 dailies instead of the weekly one. And once again, stop loss is the same thing. You will use the ATR for your stop loss, but the Sunday contract I never let expire. I never let it run to expiration. I close it at the few minutes basically before the CME opens. Okay, the S&P 500, it opens at 11 p.m. My time basically, which is here the UTC plus 2. So you need to take a look when the ES starts trading after a weekend, and 30 minutes before that you want to be out from your move contract, because usually when the legacy market opens on Sunday, there is kind of volatility kicking in to the Bitcoin as well. Funnily enough, this basically this move happened around 30 minutes before I was about to close my position. So this was kind of unlucky. You can see, this is happened at 10:30, and at 11 p.m. I'm closing my position. So this was really a bad timing, but it is what it is. So the difference between Sunday and Saturday contract, you are not letting the Sunday one expire because there is a volatility coming in to the contract itself. Okay, so these are the two short side, how I trade them. I will talk about execution in a bit. The last one is when I'm long volatility, and this is a little bit up to your discretion. First of all, if you can use something like market profile, for example, or anytime there is any kind of range, you expect a breakout and you are just not sure which side you take, you can trade these move contracts. It's quite self-explanatory, but I will kind of show you the more of a systematic way of what I do. So first thing you want to do is you will go to the Forex Factory calendar. You will filter out for the high impact news, and The news you care about is the NFP, which is this Friday. Actually, it's tomorrow. The non-farm payroll, and also the CPI, which is the inflation, and then the FOMC. Are the three news you are going to be paying attention to when it comes to longing the move contract. The another thing which is extremely important when you are about to go long is to take a look at the strike price of the contract before the news, basically. So you can see that the strike price now for this day's expiration, you can find it here, is 47,000 166. So let me plot this on the chart, and let me talk about this a little bit. 47,000, it's around here, basically. You can see already how this Bitcoin is trading at the strike price around, but the contract is decaying quite a bit during obviously the time decay. So when it comes to the high impact news, first of all, you need before the news, because obviously the news are not at the open. The FOMC is around the midday, London time. The FOMC is at the evening of the UK time, and FOMC and CPI are during the midday, basically. So first of all, when it comes to the news, you want to look at your chart, let's say 30 minutes before the news event, and the price of Bitcoin has to be around the strike price. This obviously it should be hugging this kind of daily open strike price level. If it moves too far from it, I will tell you why this is bad in a bit. And also your the move contract price also should be around the opening. This is fairly okay for me. For example, it moved only around 100 points down, so this is nothing too crazy. But if this would be trading at 200, for example, that's not really a good thing you want to see. So why you need to have this at your strike price is fairly simple. Let's say that you are buying volatility of this kind of these are kind of two scenarios where you are buying volatility with the same strike price, basically. If the market is actually trading at the strike price, this is how your PNL is going to look like. Sorry for my terrible drawing, obviously, because these lines should be actually the same. You are making money if the market is going to go to the either side. It doesn't matter if it's going to go up and down, but as long as it goes, you will make money. But if the underlying if this is your strike price, and if the underlying, which is obviously Bitcoin, is already moved $2,000 for a day, your price of the move contract is also going to be up. So you are buying a volatility here, and if the news events are not favorable for Bitcoin, then obviously Bitcoin will return to the strike price, and you will lose your PNL. It will basically go down, because obviously this is one of those misconceptions when you buy a move contract from and the underlying moved this kind of a direction from the strike price. If the market will go down, you will actually lose money, because the price of the move contract, let's say this was at 1,000, and it's trading at 2,000. If the market will go down, the price of the move contract will go back to the $1,000. So you need to have the Bitcoin trading at the strike price, okay? And yeah, so you will basically you'll go along the move contract around 5 minutes before the news release, and you will just play very short kind of a bet on the volatility coming from the news release. It's all these kind of huge candles that are caused by NFP or FOMC and CPI will make you money on the move contract. So Now, when it comes to the execution, you want to be using something like the In Silico terminal, which is free for FTX, and depends on your size you are trading. You first of all, you need to take a look at the order book. You need to have kind of a efficient counterparty for things that you do. Obviously, you don't want to be getting too big of a slippage. I would say that at any point you will kind of cross 1 BTC at your size, which is actually fairly small size. That's just a couple $1,000s in your account. You want to be kind of more smart about your execution, and what you want to do is go to the market, select the TWAP, then obviously you will add your size. You can keep your time at 5 minutes, it doesn't matter, and then you will just kind of select the D lots that will be executed in this time period. So for example, in the 10 minutes, let's say I would be selling 1 BTC or buying 1 BTC. It will execute 23 orders in the 10 minutes. So basically this is what the TWAP does, and that's kind of it. Exiting the move contract during the volatility event, you will get slipped up. That's kind of a thing that you need to understand. When there is the high volatility, getting out at exact price will be kind of unrealistic. You need to be fairly quick on the execution. You are just betting on that immediate spike of the news event, and then you want to be out from the contract. So you'll make like 500 or 1000 points, and you will just close the position. And yeah, that's basically it. Take a look at the moveproject.io. You can take a look at every single move contract that ever traded on FTX. If you are a little bit skilled in Python or some other programming language, there is this thing called QuantZone on FTX that lets you actually export all the move contracts in CSV files, so you can kind of filter out days and stuff like that. But this is very good resource for any sort of backtesting basically. You can also see here, for example, the Bitcoin price as well. Okay, so if you are really new to this, start with on the short side. The shorting is definitely easier. Use your stop loss. Don't be like me on the Sunday. And yeah, just something what I do. If you are trading with a huge size, obviously you need to understand this order book and how you should be kind of managing your position and be a little smarter on execution, which you can simply achieve with this TWAP tool on In Silico terminal. Okay, so thank you for watching.